Does this sound familiar? You've been saving up, filled out all the forms, and sent your application only to be rejected. You already know about the standard stuff, that you need a good credit score and a high income to service your debt. But what next? What do you really need to get approved for any credit card, no matter what? Well, first of all, keep a low utilization rate. Your credit utilization is a big deal. It makes up 30% of your credit score and falls under amounts owed. This utilization rate is a measure of how much credit that you're using out of your total available credit limit. Using too much, close to your limits, can hurt your credit score. And when it comes to your credit score, payment history is king, but utilization rate is a close second. So it's crucial to keep it in check if you want a healthy credit score. But don't worry, there are ways to bring your rate down fast. Like I had mentioned, this rate is determined from your total available credit limit versus how much credit that you're using. So if you're using 25% of your available credit, that means you've spent a quarter of what's available. For example, if your card has a $10,000 limit and you have a balance of $2,500, you have a credit utilization rate of 25%. If you want to calculate your ratio yourself, just add up all your credit limits, then add up all your card balances, divide what you owe by your total credit, and then multiply by 100 to get your rate percentage. If math isn't your thing, you can keep it simple and use calculators online or apps to do the work for you. Since your utilization rate plays a big part in your score, keeping it low is key to maintaining good or excellent credit. If you pile up too much debt, it will drag your score down. And while a common tip is to keep your utilization under 30%, in reality, aiming to be under 10% is much better. Ideally, you want to avoid carrying over any balance from month to month. The lower the balance, the better it is for your financial health. Paying down your balances is key to reducing your credit utilization and overall debt quickly, while also sparing you from any additional interest charges. Another option to check out is 0% introductory APR and balance transfer cards. This will allow you to combine all your debts into one card, which will have a 0% interest rate. And depending on the card, this could range from 6 to 18 months. This can be a smart way to pay off what you owe without piling up more interest charges. Additionally, consider reaching out to your card issuer to inquire about a credit limit increase. Having more credit available means your utilization goes down, but what you don't want to do is use this to push yourself into more debt. And lastly, opening a new card can also bump up your available credit, since the new card's limit will add to your total credit limit, which in turn will bring down your rate, and having a new card could possibly give you access to more rewards and perks. But why would any of this matter if your application keeps getting declined because you have low income? A lot of people get turned down for credit cards because they overlook something very important in the application form. When you apply for a credit card, they ask for your yearly income. But here's the thing, you can actually include all the money that's coming into your household, not just what you personally earn. If you're living with a spouse or a partner, you can combine your income and use that total amount. One important thing to note is that if you're under 21, they will check your individual income instead. Why does this matter? Well, credit card companies are assessing your ability to pay. With a higher income, they figure that you're able to manage your debt and pay your bills on time, which is something that they really like. So before you submit your application, remember to count all the sources of income that come into your home. It could make a big difference in whether you get approved for a card or not, as well as what your credit limit might be. However, none of that income is going to matter if you have delinquent accounts. Your track record with overdue accounts plays a big role in your credit score. If you've had instances where you missed payments, let the bills slide past their due dates, or you've had accounts handed off to collections, it could throw up some roadblocks for you. Think of delinquent accounts as those where you've dropped the ball on payments, or you haven't kept up with your financial commitments as agreed upon. Whether it's a credit card bill or a loan payment or any other form of credit, being delinquent paints a not so great picture of reliability when it comes to handling money matters. If you miss payments, even by just a bit, it can mess with your credit report and make credit card companies wonder if you're handling your money right. And if any of your accounts end up in collections because you haven't paid or defaulted, it's like a big red flag to lenders, hinting that you probably are a risky borrower. Just note that missed payments won't show up on your report until at least 30 days after they're due, but you'll still get hit with those late fees. To up your chances of getting the green light for any credit card that you have your eye on, it's important to take charge and tackle any overdue accounts head on. Start by getting in touch to square away any outstanding payments or debts that have slipped through the cracks. Showing that you're committed to sorting out past financial slip-ups can help ease concerns about your trustworthiness and boost the chances of getting the thumbs up. And don't forget to turn over a new leaf by making sure all your payments are on the money moving forward. By facing up to past delinquencies and making sure you're on top of payments going forward, you're on the right track to beefing up your credit worthiness and improving your credit score. I already mentioned it earlier, it's pretty easy for people to tell you to just improve your credit score, but there are tons of factors that could affect your score. Are you starting without a credit history? Or maybe you're on the other end and you've had some issues and need to rebuild your credit score. Well, don't worry, because I'll be sharing some tips on how to help with both of these possibilities. If you've been dealing with bad credit, you need to keep track of your credit score. You can get a credit report from a variety of sources, but what's important is to know where you're currently standing. Depending on the lender that you choose, there are two companies that run the majority of the credit scoring space. That's the FICO and the Vantage score. They both have a credit score range starting from 300 up to 850, but they look at different factors to determine your score. Now, since 90% of consumer lending is based on FICO scores, it's the most important to look at, and that's what I'm referring to when I talk about your credit score. Once you have a copy of your credit score and report, give it a thorough once over and make sure to fix any inaccuracies. If you're faced with judgments, there may be methods to get them removed, either by obtaining creditor approval or seeking court intervention. Once you've addressed the discrepancies in your credit report, you'll need to start rebuilding your score. Stay on top of your financial commitments, from your credit cards to your mortgage or any other loans, and don't forget about those monthly bills. Paying them on time may not grab headlines, but it's a solid step in financial responsibility. If you're trying to build credit as fast as you can go easy on the credit card applications. They can put a dent in your score. And while there is no shortage of tricks to boost your credit rating, keeping tabs on your finances is the simplest game plan out there. Now, how about if you're starting with a clean slate without any credit at all? Well, here are some ways where you can improve your credit score as a beginner. One option is to become an authorized user on someone else's credit card. This allows you to piggyback off their positive payment history and their credit age to help establish your own credit. However, it is essential to ensure that the lender reports authorized user accounts to the credit bureaus for the strategy to be effective. On the other hand, applying for a secured credit card can also be a straightforward way to establish credit, as it requires a deposit up front to secure the credit line. Shopping around for the best option is crucial, as some secured cards may charge annual fees, while others may have no fees and come with added perks and benefits. Store cards and having rental payments reported through rent reporting services can also help towards building credit. Although it's important to be mindful of interest rates and your payment habits to ensure positive outcomes. But now that you've got a relatively good credit score, how do you check which cards you may be eligible for without actually applying? Pre-approval offers give you a heads up on whether you're likely to get approved for a specific credit card without hurting your score. While they don't guarantee approval, they can increase your chances. Pre-approval offers work like this. Credit card companies do a soft check on your credit report to see if you're a good fit for their card. These soft checks don't hurt your credit score like the hard ones do when you apply for new credit. They just let the credit card companies review the info that you provided, along with taking a peek at your credit history or score to decide if you're a match for their card. Getting a pre-approval offer means you've already cleared some basic requirements set by the credit card issuer. It's like a green light that says you look like you meet the criteria, but the final approval depends on a deeper dive into your financial history, income, and other details. Using pre-approval offers can come in handy if you're unsure about the chances of getting a specific credit card. By responding to these offers, you can test the waters without fully committing with an application and possibly getting a hard inquiry. This can also shield you from potential credit score dips that come with one or multiple denials. To check out pre-approval offers, keep an eye on your mailbox for personalized mailings from the credit card companies, as well as your email. If you have accounts or other products with some banks, you can also hop onto their websites to see if you've got any pre-approved offers waiting for you. Just remember, these offers are based on the info available to the issuer at the time, so your eligibility might change based on your financial situation. In a nutshell, tapping into pre-approval offers gives you a peek into your chances of scoring a credit card while keeping your credit score intact. While they don't guarantee approval, they are a helpful tool for boosting your odds and making smart decisions when it comes to applying for credit cards. So you have a solid credit history and you've done everything you can to make your application perfect. But despite all that, you still get denied. At this point, there's a high chance that your application is being automatically denied by the system. But that's okay, because there's one last trick that you can pull to try and turn things around. You can take advantage of what's known as a reconsideration process, which essentially involves reaching out to the credit card issuer and asking for a second look at your application. By speaking with the representative on their reconsideration line, you have the opportunity to talk about the reasons for your denial and to provide additional context about your financial situation, highlighting your responsible credit management history. This will allow you to really advocate for yourself and potentially sway the decision in your favor. Now, it's important to remain polite and patient during this process, as the outcome may depend on your ability to communicate effectively. If you get a rep who isn't helpful, don't sweat it. It's okay to hang up and call back to speak with someone else. Sometimes you just need to be patient and persistent, which is a pretty good motto to keep in mind when it comes to your journey with credit. If you're interested in learning more about how to improve your credit score, make sure to check out my video about it here. As always, thank you for watching, and I'll see you in the next one.